Hey guys, it's Jerome and today is Friday, which means that I'm back with another video and hopefully I'm going to continue to put out at least one video a week on Fridays. So if you guys like these videos, make sure you hit the thumbs up down below, subscribe to the channel, and yeah. So now that we have that out of the way, let's move on to the topic today, and that's MBA loans and how long it's going to take to pay those back. So let's get right into the video. So the biggest question that most people probably have is how much money am I going to have to borrow for my MBA and how long is it going to take for me to pay that back? Typically MBA loans have loan terms anywhere from 5, 10, 15, even 20 years long, but most people don't want to hold on to loans for 20 years. CNBC had an article from back in 2017 that said the average MBA student is going to borrow about $66,000. We see in this article that pre-MBA, these students earn about $80,000, and then after their MBA, they end up making about $115,000. So I wanted to take those numbers, figure out how much disposable income you're going to have, and how much money you can actually put towards your student loans to see if you can pay it off as fast as possible. So there's going to be a couple different options when you actually go and apply for your student loans. For instance, you can go with federal loans, you can go with private loans, and depending on which one you choose, your options for repayment are going to be a little bit different. If you remember from before, we said that your average MBA student is going to have about $66,000 in loans. And so that's going to probably be some sort of mix of federal and private loans, but you don't really have to worry about that. All that really means is your federal loan's probably going to be at one interest rate and your private loan's going to be at a different interest rate. So your overall interest rate is going to be somewhere in between those two. For the purpose of this video though, we're going to go ahead and assume that you borrowed all of your money from one place and you just have one flat interest rate. So the assumption we're going to make then is that your interest rate is going to be 4.5%, you're borrowing $66,300, and you're going to have a term length of 20 years. That way you get the lowest monthly payment up front. So the first thing that you have to realize is interest starts growing on that money that you borrowed immediately, as in like day one. That's really important to know because those first 2 years that you're in school, more than likely you're not paying back any amount on your loans. So that entire $66,000 is going to be growing interest that entire time. So that $66,000 is actually going to be closer to about $72,000, almost $73,000 because of all that interest it's gaining. So what's our monthly payment going to be? Well, if you look right here, you can see that it's going to be about $458 a month. And if you pay that every single month for 20 years, you're going to have finally paid off that loan, but you're going to have paid about $44,000 in interest. That means for that $66,000 that you borrowed for school, you're actually going to end up paying over $110,000 for it. So how do we lower the amount of interest that we're paying and minimize the amount of time that we have that loan for? So one really simple option is actually just to make bi-weekly payments instead of monthly payments. By making bi-weekly payments, what you're essentially doing is making a 13th monthly payment every single year. Essentially, you're going to be making an extra payment every single year, and that's going to cut down on your loan term by 2.5 years, saving you about $5,000 in interest. So in the same way, if we just continue to make our monthly payments larger and larger and larger, that's going to be the fastest way that you're going to pay off that student loan. So how do we actually do that? Well, the easy answer is obviously just live a more frugal lifestyle and spend less money elsewhere, so then you have a larger disposable income that you can put towards that loan. We need to figure out what our disposable income is going to be. And to do that, we need to figure out what our starting salary is going to be, how much we owe in taxes, what our expenses are, and all that stuff. But lucky for you guys, I went ahead and did all the calculations for you. We're going to start with the $116,000 that we found as the average pay for an MBA graduate. After that, we need to take out taxes. But before we can do that, there's some pre-tax contributions you can choose to make that will lower your taxable income and basically save you some money in taxes. So the first thing I would recommend is to maximize those pre-tax contributions. That way you're not going to be paying as much in taxes and you're going to get to keep more of your own money. So first, let's maximize our 401k. That's going to be $19,000 a year. So we're going to take that out of our salary. Next, we're going to maximize our HSA account, which is a health savings account that most companies have started to offer. Basically, what that accounts for is any of your medical expenses. Typically, you'll be provided with a debit card that's linked to that account, and then anytime you get medical expenses, you can use that account to pay for those, and that's money, again, that's pre-tax. So again, we're going to try to max that account out at $3,550 a year. So we're going to take that out of our salary. Some other expenses that sometimes come out pre-tax are things like health insurance, vision, dental. So we're going to take that stuff out here as well. Obviously, income taxes are going to be different based on where you live. So I didn't want to pick a place like Tennessee because we don't have any state income tax at all. But I also didn't want to pick a place like New York City because they have not only state income tax, but also city income tax. So I tried to find a nice little middle ground. So I decided Illinois was a good one because they have a flat 4.9% state income tax on everything. So we're going to use that. After all of our deductions that we've made, we see that we end up with a taxable income of a little over $93,000. And that means we're going to be ending up paying about $2,400 a month in taxes. At this point, a lot of people would probably just go ahead and move on to their monthly expenses like rent, Wi-Fi, utilities, things like that. But I personally like to take this number and take 20% out of it and put it in a savings account as an emergency fund. Personally, I like to do it this way and think of it as whatever remaining you have after your savings to be what your real budget is for how much you can afford in rent and groceries and things like that, just because that way you're setting aside a savings buffer first and you're not having to come back at the end of the month and scrap together everything that you have left over and put it in a savings account. You're going to go ahead and essentially pay yourself first. So once we take that 20% away, we're left with about $51,000 for the year, and this is what we're going to use for our living expenses. For our expenses, I've included rent, utilities, Wi-Fi, groceries, car payments, and I've used the national average for all of these things. And don't forget our actual loan payment of $450 a month that we calculated before. And when you add up all those expenses, it comes out to just about $40,000 a year. That leaves us with just over $11,000 for the year, or $950 a month. And that's what we're going to consider our disposable income. And that's what we're going to use to accelerate our loan payments. So let's see what happens if we just take half of that disposable income and apply it towards our student loan debt every single month. You can see by just doing this, you're going to be paying off that loan insanely fast, and you can actually pay it off in just 7.5 years after graduation. And the best part about this is you still have half of that disposable income, about $475 left over to do whatever you want with. But let's see if we can pay it off even faster. What would happen if we ended up putting all of that disposable income, all $950, into our loan payment every single month? By doing that, you're going to finish paying back that loan in 5 years after graduation, and you're going to save about $30,000 in interest payment. But we all know what you're really here for. It's to ask that question that's in the title. How do I pay back my loans in 2 years? Well, clearly we need to find some more places in our budget that we can trim a little bit of money out of so we can put more into those loan payments. So the biggest places that we can do that right now are going to be your 401k, your HSA, and your savings account. But remember that your 401k and HSA are pre-tax, and so if you lower your contribution every single month, you're actually going to end up paying a little bit more in taxes. Before we go any further, I want to make it 100% clear that I do not recommend that you do this. Maxing out your 401k is actually probably pretty rare, especially at my age, so you do have a little bit of wiggle room there. At the very least, you want to make sure you're contributing enough that you're getting your company's match amount for their 401k, because that's just free money that you'd be missing out on if you didn't. Basically, the way that works is a company will say, will match 50 cents for every dollar that you contribute up to 6% of your salary. So if that's the case, then you want to make sure you're contributing at the very least 6% of your salary to your 401k, because anything less than that, you're just missing out on money that your company would be giving you for free. For the HSA, like we talked about before, it is just a health savings account that you can use just for medical expenses. So really, if you have a lot of money saved up elsewhere and you can pay for medical expenses, or if you're young and you don't expect to have a lot of medical expenses, then maybe you can get rid of that altogether. As for the savings account, I really don't recommend that you completely get rid of it. I really do think everyone should have some sort of emergency fund, because you never know what's going to happen financially. So maybe instead of contributing 20% to it, you can do 10%. After making all of those adjustments, you're going to be left with about $2,300 left over every single month. And if you put all of that money towards paying back your student loans, you can pay it back in 27 months and save over $35,000 in interest. As you can see, while this can be done, it's probably not very realistic, and I think you should focus on prioritizing your 401k and your savings account more so than just paying off this loan a couple years sooner. To be honest with you, it's actually probably better to keep that loan for the entire 20 years and take that disposable income you had and put it in the stock market instead. But we can talk about that in a different video. Well, that's all I had for this one, guys. If you liked the video, please hit the thumbs up down below, subscribe to the channel, and share with all of your friends. We are on our way to getting to 1,000 subscribers and making YouTube partners, so I need you guys to continue supporting me, continue watching the videos, tell your friends. Thanks for watching, guys, and I'll see you next time. Peace.